Hi, I'm Jim Jubak, and welcome to my YouTube video for, Wednesday, February 10th. If you like this video, please like it. If you'd like to see more of my YouTube videos, please subscribe to the channel. That way you'll get a notification when a new one pops up. You can also find more of my stuff on my free site, jubakpicks.com, and that includes a couple of the portfolios we'll be talking about today, especially the dividend portfolio. Or you can get even more stuff on my subscription site, jubakam.com, and that's got the dividend portfolio, it's got the volatility portfolio, and it's got the new Millennium portfolio, as well as my ETF portfolio. So lots of stuff that we're going to be talking about today on those two sites. So we're staying in the minor league baseball theme. This is a renamed minor league team. This is from the Las Vegas minor league franchise, now called the Las Vegas Aviators. It used to be called the Las Vegas 51s after Area 51, where we all know the Air Force has hidden all of the aliens that have visited the United States. So new hat, same theme. Let's go to today's topic. Today's topic is avoiding diversification in 2021, particularly finding alternatives to bonds and gold. Diversification is it's a play on diversification. It's a Wall Street coinage. We diversify portfolios to hedge our risks. So we don't want to be all in stock because, hey, maybe stocks will go down. So we'd add some bonds to it. And maybe we're worried about inflation. So maybe we add some gold to that. The whole idea is to come up with a portfolio with less risk, less volatility. The problem is that sometimes when you diversify a portfolio, you add assets that are going to perform worse than your sort of baseline. And that's particularly a problem when you know going in that that's going to be the case. And then you have something called diversification, which is that you're adding assets that actually lower your return without doing anything really to help your overall risk. And that's what I think we're looking at in 2021. 2020 was a great year for diversification because it was pretty easy. So for example, if you had bought simply the iShares 7 to 10 year Treasury bond ETF, and let's go to the chart, you would have shown a return of a little over 10% in 2020. Now you're adding this to diversify, but you're not losing a whole lot. I mean, the major stock indexes were up 15-16%. So yes, you did not do as well, but you got the risk hedge of owning Treasury bonds, which are a very stable, very liquid asset, without giving up a whole lot of performance. Same thing with something like gold. You could add gold as a hedge against inflation, as a hedge against a lower dollar. And in 2020, that was a pretty easy piece of diversification. In 2020, the GLD, which is the gold, the SPDR gold shares, so this is an ETF which owns physical gold, returned 24.81%. So by adding this, you didn't lose anything from a whole stock portfolio. You actually did better than stocks did in 2020. The problem is, as we look forward into 2021, this doesn't look like it's going to be the same situation. In fact, it looks like right now that we're going to see bonds and gold underperform. If we go back to the bond chart, you'll notice that what's happened is that the bonds, the price of this ETF, the value of this ETF is falling. And it's falling because the yield on long-term treasuries has climbed from about 0.6% in the summer of 2020 low to about 1.16% yesterday. And remember, as yields go up, bond prices go down. So what you're really looking at here is an asset which has been costing you for the diversification that it adds to a portfolio. This wouldn't be a problem if we were looking at a quick turnaround, but everybody on Wall Street is saying, hey, it looks like we're going to see a continued increase in yields on 10-year treasuries. And people are saying the end of the year treasury is going to be about 1.9%. So from 1.16, 1.18 to 1.9, if you held on for that ride, you'd lose about 30% or more of the value of your bond. That's not a good way to diversify. Same problem with gold. If you look and see, let's go back to find the gold ETF. You'll notice what's really happened is that gold has been, we'll take this, just take the very short term, gold has been in a downturn. So that for year to date for 2021, gold, the GLD, the gold shares fund ETF, has lost about 3.5%. And people are saying, hey, we really don't see a lot of inflation showing up, although inflation is starting to rise. But what we are seeing is interest rates, especially on long bonds, yields on long bonds going up, which makes them more attractive versus gold. Gold tends to perform badly when interest rates are going up, so that we're looking at a continued drop in gold for the rest of 2021. Not certain, but that's the prediction for the trend right now, which means that adding gold to a portfolio wouldn't give you much in the way, it would give you diversification, but it would give you what I'm calling diversification, which means that you'd be adding an asset to hedge against risk that you're pretty sure is going to be going down. So what do you look at instead of those? One thing is dividend stocks. On my two sites, jubakpicks.com and jubakam.com, I've constructed a portfolio of dividend stocks. That portfolio went up about 15.7% in 2020. So you had an asset which was less risky than stocks as a whole, but performed about as well as the market as a whole. So you can track that, you can look at that portfolio going forward. You can buy some of the stocks in that portfolio. You don't have to buy the whole portfolio. So utility stocks, AES, which is up about 9.6% since I added it on the 10th of January. New Era Energy up about 11.5% since I added it. Duke Energy up about 2%. But you also get dividends with these, and so even in a utility like Eversource, you're getting where the gain is only 0.6% since I added it to the portfolio, still getting dividends. And the thing I like about utilities of this kind going forward is they pay a dividend, so they're not as risky as the stock market as a whole. They do correlate more strongly with stocks than they do with bonds, but they're somewhere in the middle. You're also looking at stocks that will do better as the economy recovers, because people and industry will be buying more power, so they'll be getting more revenue. As well as you're looking at, if you pick the right utilities, you're getting utilities that are at the forefront of the transition to solar and wind power, and it's a complicated transaction for the utilities and state regulators that I try to explain in some of my posts. But basically, as a company sort of adds new wind power generating capacity that gets added into the rate base, the regulator says, hey, you're entitled to a 6 or a 9% or a 10%, whatever, return on your investment. So adding new power sources actually adds to the rate base that the utility is making its revenue on, as well as the decommissioning, if you want to call it that, of older coal plants also is a big cost. And in a lot of states, it's getting that cost of taking old coal-fired power plants out of generating capacity is getting added to the rate base since someone's got to pay for it. So regulators are saying, hey, customers have to pay for it. So those things are adding to the rate base too. So you're getting a kind of big push in that direction. You don't have to buy the stocks in my portfolio. There's a portfolio an ETF that I'd suggest called the ProShares S&P 500 Dividend Aristocrats. These are the shares of companies in the S&P which have raised their dividend for every year over the last 25 years. The ETF's ticker is Noble, N-O-B-L. It didn't do as well as my portfolio in 2020, but it did very well. It did 8.4%. So far, year to date, it's up about 2%. Again, not as well as my portfolio as a whole, but it's because my portfolio is more concentrated on utilities, which have been doing better than dividend stocks as a whole. You could also have bought the Utilities Select Sector Spider. The symbol there is XLU, and that would have given you, it doesn't have exactly the same mix. You would have made some money in 2020. It was up about half a percentage point. Year to date, it's up about 3/4 percentage point. Again, not doing as well as my dividend portfolio, but hey, these are ETF alternatives. Okay, so what else might you want to look at? Well, instead of gold, how about copper? And I'm going to look at a couple of copper ETFs. The thing you notice here, this is for the Global X Copper Miners ETF. These are copper miners, therefore it's leveraged more to the price of copper, as in gold miners are more leveraged to the price of gold than gold itself. So you notice here, you're really talking about a commodity that has been on the real upswing since November. It's a commodity as inflation goes up and weakens the dollar. This goes up. It's better than gold in a situation where the economy is getting stronger, because copper is one of the things that it has a lot of industrial uses, so you're not simply trying to get a financial hedge. And the last thing is that the amount of copper used in a car is on a way, way, way uptrend as we make the transition from internal combustion engines to electric vehicles. The amount of copper goes up about anywhere from 50 to 150%, depending on whose numbers you use. So you got that trend going in your right direction. You've got a commodity that hedges against a falling dollar and inflation, and that has some leverage to the improving economy as a whole. You can also just buy the commodity as a whole. This is an ETF called United States Copper Index, which owns copper futures. So you're looking at something that really doesn't have the leverage of the copper miners, but it's doing really well because copper prices have been going up. So in 2020, this one went up about 24%. So far, year to date, it's up about 5.6%. I'll be adding one or the other of these to my portfolios in the next, probably today or tomorrow, to try to, give myself a little more hedge in my portfolio. I'll be replacing gold. I'm replacing the gold ETF with one of these. So I think that 2021 is going to be, a tough year. Not so much for the first half of the year, maybe for the first 6 months or so, because I think vaccines will start to control the pandemic, or at least will start to feel they're controlling the pandemic. So we'll get optimism that the economy is going to be growing or returning to normal. It's the second half of the year that bothers me, because as we get into a kind of a when you lose, you lose, when you win, you lose situation with the Fed, which is if the Fed sees the economy getting stronger, it's going to at least start making noises about cutting back on its bond buying, currently buying about $120 billion worth of treasuries and mortgage-backed assets a month. At some point, they'll stop doing that. They won't do that until the economy looks like it's relatively robust, but I think Wall Street will start to worry about that before it actually happens. So the last half of the year is one where I think you want to worry about hedging stock market risk, and these are a couple ways to do it. Thanks for watching. It's been Jim Jubak on my YouTube channel. You can find more of my stuff on jubakpicks.com. Jubakam.com is my subscription site. If you like this video, please like it. If you want to see more of it, subscribe to my YouTube channel. That way you'll get notification that it's coming every time I put up a new video. Thanks very much for watching.